Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, thank you for tuning in. It's great to have you here. In his opening remarks at the 2021 Berkshire Hathaway Annual Shareholders Meeting, Warren Buffett said a few things that made me go, wait a minute, I've heard this before. And what I realized then is what I want to share with you now. Some of the main points that Warren Buffett made at this year's Berkshire meeting, specifically in his opening remarks, were nearly identical to the main points that Warren Buffett made when he was the final presenter at the Sun Valley Conference in 1999. This presentation in Sun Valley was a big moment in Buffett history. It was the first time that Warren Buffett publicly made any kind of prediction about the future of the stock market. Now, I don't know about you, but I was not an active investor in 1999. I don't even think I knew who Warren Buffett was. Thankfully, I read The Snowball, which is the critically acclaimed biography about Warren Buffett by Alice Schroeder. The Washington Post describes The Snowball as, and I quote, the most detailed glimpse inside Warren Buffett and his world that we likely will ever get. Chapter 2 of The Snowball is all about the 1999 Sun Valley Conference. In this episode, I'm going to read directly from that chapter. It's very entertaining. Even if you live through the time period, I think you'll still enjoy it. It'll also give you a lot to think about the current state of the stock market. I don't want to influence any of the conclusions that you may or may not make. Let me just get out of the way and let's get to this chapter. I'm really excited to share it with you. So without further ado, let's get to it. The following story took place in July of 1999 in Sun Valley, Idaho. This year, as the cocktails and camaraderie flowed, the babble of a barely comprehensible new language, B2B, B2C, banner ads, bandwidth, broadband, competed with the sounds of the band. All week long, a vague sense of unease had drifted through the lunches and dinners and cocktails, like a silent fog amid the handshakes, kisses, and hugs. A new group of recently minted technology executives, filled with an unusual swagger, introduced themselves to people who had never heard of them a year before. My name's Bill, and I'm very rich. Some displayed a hubris that was at odds with Sun Valley's usual atmosphere, where a determined informality reigned. The cloud of arrogance hung heaviest over the presentations that were the conference's centerpiece. Heads of companies, high government officials, and other people of note gave talks unlike those they delivered anywhere else, because hardly a word of what was said was ever whispered beyond the flower boxes hanging by the doors of the Sun Valley Inn. The new moguls of the internet had been strutting, trumpeting their latest mergers and looking to raise cash from the money managers sitting in the audience. The money people, who stewarded other people's pensions and savings, together commanded so much wealth that it could hardly be comprehended. More than $1 trillion. With $1 trillion in 1999, you could pay the income tax of every single individual in the United States. You could give a brand new Bentley automobile to every household in more than 9 states. You could buy every single piece of real estate in Chicago, New York City, and Los Angeles combined. Some of the companies making presentations needed that money, and they wanted this audience to give it to them. Early in the week, Tom Brokaw's panel, called The Internet and Our Lives, had drum-majored a procession of presentations about how the internet would reshape the communications business. One after another, executives laid out the glittering prospects for their companies, filling the room with an intoxicating vapor of a future unlimited by storage space and geography, so slick and visionary that while some were convinced that a whole new world was unfolding, others were reminded of snake oil salesmen. The folks who ran technology companies saw themselves as Promethean geniuses, bringing fire to lesser mortals. Other businesses that grubbed in the ashes to make the dull necessities of life, auto parts, lawn furniture, were now of interest mostly for how much technology they could buy. Some internet stocks traded at infinite multiples of their non-existent earnings, while quote-unquote real companies that made real things had declined in value. As technology stocks overtook the old economy, the Dow Jones Industrial Average had burst through the once distant 10,000-point barrier only 4 months before, doubling in less than 3.5 years. Many of the recently enriched congregated between speeches at a cordoned-off dining terrace by the duck pond. The next morning, Buffett rose early, for he would be the closing speaker of the year. Invariably, He turned down requests to speak at conferences sponsored by other companies, but when Herbert Allen asked him to speak at Sun Valley, he always said yes. The Saturday morning closing talk was the keynote event of the conference, so instead of heading straight to the golf course, almost everyone went to the Sun Valley Inn, then settled into a seat. Today, Buffett would be talking about the stock market. In private, Buffett had been critical of the gunslinging, promoter-driven market that had sent technology stocks galloping towards delirious heights all year. The stock of his company, Berkshire Hathaway, languished in their dust, and his rigid rule of not buying technology stocks seemed outmoded. But the criticism had no influence on how he invested, and to date, the only public statement he had made was that he never made market predictions. So his decision to do just that at Sun Valley was unprecedented. Perhaps it was the times. Buffett had a firm conviction and an overwhelming urge to preach. He had spent weeks preparing for this speech. He understood that the market was not just people trading stocks as though they were chips in a casino. The chips represented businesses. Buffett thought about the total value of the chips. What were they worth? Next, he reviewed history, pulling from an exhaustive mental file. This was not the first time that world-changing new technologies had come along and shaken up the stock market. Business history was replete with new technologies: railroads, telegraph, telephone, automobiles, airplanes, television, all revolutionary ways to connect things faster. But how many had made investors rich? He was about to explain. Now let's jump ahead to when Buffett takes the stage. I would like to talk today about the stock market, Buffett said. I will be talking about pricing stocks, but I will not be talking about predicting their course of action next month or next year. Valuing is not the same as predicting. In the short run, the market is a voting machine. In the long run, it's a weighing machine. Weight counts eventually, but votes count in the short term, and it's a very undemocratic way of voting. Unfortunately, they have no literacy tests in terms of voting qualifications, as you've all learned. Buffett clicked a button, which illuminated a PowerPoint slide on a huge screen to his right. Bill Gates, sitting in the audience, caught his breath until the notoriously fumble-fingered Buffett managed to get the first slide up. Now, this slide showed the Dow Jones Industrial Averages on December 31st, 1964, and then December 31st, 1981. Buffett walked over to the screen and started explaining. During these 17 years, the size of the economy grew fivefold. The sales of the Fortune 500 companies grew more than fivefold. Yet during these 17 years, the stock market went exactly nowhere. He backed up a step or two. What you're doing when you invest is deferring consumption and laying money out now to get more money back at a later time. And there are really only two questions. One is how much you're going to get back, and the other is when. Now, Aesop was not much of a finance major because he said something like, a bird in the hand is worth two in the bush. But he doesn't say when. Interest rates, the cost of borrowing, Buffett explained, are the price of when. They are to finance as gravity is to physics. As interest rates vary, the value of all financial assets, houses, stocks, bonds, changes, as if the price of birds had fluctuated. And that's why sometimes a bird in the hand is better than two birds in the bush, and sometimes two in the bush are better than one in the hand. In his flat, breathy twang, the words coming so fast that they sometimes ran over one another, Buffett related Aesop to the great bull market of the 1990s, which he described as baloney. Profits had grown much less than in that previous period, but birds in the bush were expensive because interest rates were low. Fewer people wanted cash, the bird in the hand, at such low rates. So investors were paying unheard of prices for those birds in the bush. Casually, Buffett referred to this as the greed factor. The audience, full of technology gurus who were changing the world while getting rich off the great bull market, sat silent. They were perched atop portfolios that were jam-packed with stocks trading at extravagant valuations. They felt terrific about that. It was a new paradigm, this dawning of the internet age. Their attitude was that Buffett had no right to call them greedy. Warren, who'd hoarded his money for years and given very little away, who was so cheap his license plate said thrifty, who spent most of his time thinking about how to make money, who had blown the technology boom and missed the boat, was spitting in their champagne. Buffett continued, There were only 3 ways the stock market could keep rising at 10% or more a year. One was if interest rates fell and remained below historic levels. The second was if the share of the economy that went to investors, as opposed to employees and government and other things, rose above its already historically high level. Or, he said, the economy could start growing faster than normal. He called it wishful thinking, to use optimistic assumptions like these. Some people, he said, were not thinking that the whole market would flourish. They just believed they could pick the winners from the rest. Swinging his arms like an orchestra conductor, he succeeded in putting up another slide while explaining that although innovation might lift the world out of poverty, people who invest in innovation historically have not been glad afterward. Quote, "This is half of a page which comes from a list of 70 pages long of all the auto companies in the United States." He waved the complete list in the air. There were 2,000 auto companies, the most important invention probably of the first half of the 20th century. It had an enormous impact on people's lives. If you had seen the time of the first cars, how this country would develop in connection with autos, you would have said, "This is the place I must be." But of the 2,000 companies, as of a few years ago, only 3 car companies survived. And at one time or another, all 3 were selling for less than book value, which is the amount of money that had been put into the companies and left there. So autos had an enormous impact on America, but in the opposite direction on investors. He put down the list to shove his hand in his pocket. Quote, "Now sometimes it's much easier to figure out the losers. There was, I think, one obvious decision back then. And of course, the thing you should have been doing was shorting horses." Click. A slide about horses popped up. And this slide shows the U.S. horse population in 1900, which was 17 million, and then in 1998, 98 years later, it is 5 million. Buffett continues, "Frankly, I'm kind of disappointed that the Buffett family was not shorting horses throughout this entire period. There are always losers." Members of the audience chuckled, albeit faintly. Their companies might be losing money, but in their hearts beat a conviction that they were winners, supernovas blazing at the cusp of a momentous shift in the heavens. Click. Another slide appeared. Buffett continues, "Now, the other great invention of the first half of the century was the airplane. In this period from 1919 to 1939, there were about 200 companies. Imagine if you could have seen the future of the airline industry back there at Kitty Hawk. You would have seen a world undreamed of. But assume you had the insight, and you saw all these people wishing to fly and to visit their relatives or run away from their relatives or whatever you do in an airplane, and you decided this was the place to be. As of a couple years ago, there had been zero money made from the aggregate of all stock investments in the airline industry in history. So I submit to you, I really like to think that if I had been down there at Kitty Hawk, I would have been far-sighted enough and public-spirited enough to have shot Orville down. I owed it to future capitalists." Another light chuckle. Some were getting tired of these musty old examples, but out of respect, they let Buffett get on with it. Now he was talking about their business. Quote, "It's wonderful to promote new industries because they are very promotable. It's very hard to promote investment in a mundane product. It's much easier to promote an esoteric product, even particularly one with losses, because there's no quantitative guideline." This was goring the audience directly, where it hurt. Buffett continues, "But people will keep coming back to invest. It reminds me a little of that story of the oil prospector who died and went to heaven. And St. Peter said, 'Well, I checked you out and you meet all the qualifications. But there's one problem,' he said. 'We have some tough zoning laws up here, and we keep all the oil prospectors over in that pen. And as you can see, it is absolutely chock full. There's no room for you.' And the prospector said, 'Do you mind if I just say 4 words?' St. Peter said, 'No harm in that.' So the prospector cupped his hands and yells out, 'Oil discovered in hell!' And of course, the lock comes off the cage, and all of the oil prospectors start heading right straight down. St. Peter said, 'That's a pretty slick trick. Go on in, make yourself at home. All the room in the world.' The prospector paused for a minute, then said, 'No, I think I'll go along with the rest of the boys. There might be some truth to that rumor after all.' Well, that's the way people feel with stocks. It's very easy to believe that there's some truth to that rumor after all." This got a mild laugh for a half second, which choked off as soon as the audience caught on to Buffett's point. which was that, like the prospectors, they might be mindless enough to follow rumors and drill for oil in hell. He closed by returning to the proverbial bird in the bush. There was no new paradigm, he said. Ultimately, the value of the stock market could only reflect the output of the economy. He put up a slide to illustrate how, for several years, the market's valuation had outstripped the economy's growth by an enormous degree. This meant, Buffett said, that the next 17 years might not look much better than that long stretch from 1964 to 1981, when the Dow had gone exactly nowhere. That is, unless the market plummeted. If I had to pick the most probable return over that period, he said, it would probably be 6%. Yet a recent Payne-Weber Gallup poll had showed that investors expected stocks to return 13 to 22%. He walked over to the screen. Waggling his bushy eyebrows, he gestured at the cartoon of a naked man and woman, taken from a legendary book on the stock market, titled Where Are the Customers' Yachts? I have that book, by the way, and I just need to get around to reading it. The man said to the woman, "There are certain things that cannot be adequately explained to a virgin either by words or pictures." The audience took his point, which was that people who bought internet stocks were about to get screwed. They sat in stony silence. Nobody laughed. Nobody chuckled or snickered. Seeming not to notice, Buffett moved back to the podium and told the audience about the goodie bag he had brought from them from Berkshire Hathaway. "I just bought a company that sells fractional jets, net jets," he said. "I thought about giving each of you a quarter share of a Gulfstream 4, but when I went to the airport, I realized that'd be a step down for most of you." At that, they laughed. So he continued. He was giving each of them a jeweler's loupe instead, which he said they should use to look at one another's wives' rings, the third wives especially. That hit its mark. The audience laughed and applauded. Then they stopped. A resentful undercurrent was washing through the room. Sermonizing on the stock market's excesses at Sun Valley in 1999 was like preaching chastity in a house of ill repute. The speech might rivet the audience to its chairs, but that didn't mean that they would go forth and abstain. Yet some thought they were hearing something important. "This is great. It's the basic tutorial on the stock market, all in one lesson," thought Bill Gates. The money managers, many of whom were hunting for cheaper stocks, found it comforting and even cathartic. Buffett waved a book in the air. Quote, "This book was the intellectual underpinning of the 1929 stock market mania. Edgar Lawrence Smith's Common Stocks as Long-Term Investments proved that stocks always yielded more than bonds. Smith identified 5 reasons, but the most novel of these was the fact that companies retained some of their earnings, which they could reinvest at the same rate of return. That was the plowback, a novel idea in 1924. But as my mentor Ben Graham always used to say, you can get in way more trouble with a good idea than a bad idea. Lord Keynes, in his preface to this book, said, "There is a danger of expecting the results of the future to be predicted from the past." Buffett had worked his way back around to the same subject, that one couldn't extrapolate from the past few years of accelerating stock prices. "Now, is there anyone I haven't insulted?" He paused. The question was rhetorical. Nobody raised a hand. "Thank you," he said, and ended. Praise by name, criticize by category was Buffett's rule. The speech was meant to be provocative, not off-putting, for he cared a great deal what they thought of him. He had named no culprits, and he assumed they would get over his jokes. His argument was so powerful, almost unassailable, that he thought even those who didn't like its message must acknowledge its force. And whatever unease the audience felt was not expressed aloud. He answered questions until the session ended. People began to stand, awarding him an ovation. No matter how they saw it, a masterful exposition on how to think about investing, or the last roar of an old lion, the speech was by any standard a tour de force. Buffett had stayed on top for 44 years in a business where 5 years of good performance was a meaningful accomplishment. Still, as the record lengthened, the question always loomed. When would he falter? Would he declare an end to his reign, or would some seismic shift dethrone him? Now, it seemed to some, the time had come. It may have taken an invention as significant as the personal computer, coupled with a technology as pervasive as the internet, to topple him, but he'd apparently overlooked information that was freely available and rejected the reality of the approaching millennium. As they muttered a polite, "Wonderful speech, Warren," the young lions prowled. And so, even in the ladies' room at the break, sarcastic remarks were heard from the Silicon Valley wives. It was not just that Buffett was wrong, as some felt, but that even if you were eventually proved right, as others suspected he would be, his dour prediction of the investing future contrasted so sharply with Buffett's own legendary past. For in his early glory days, stocks were cheap, and Buffett had scooped them up in handfuls, almost alone in noticing the golden apples lying untouched on the path. As the years passed, barriers grew up that made it harder to invest, to get an edge, to figure out what others didn't know. So who was Buffett to preach at them, now that it was their turn? Who was he to say that they shouldn't make money while they could off this wonderful market? Throughout the rest of the lazy afternoon, Herbert Allen's guests played one last game of tennis or golf, or headed to the duck pond lawn for a leisurely chat. Buffett's old friends congratulated him on his triumph of a speech. He believed he had done a convincing job of swaying the audience. He had not given a speech full of such commanding evidence simply to go on the record. Buffett, who wanted to be liked, had registered the standing ovation, not the mutterings. But the less flattering version was how many were not convinced. They believed that Buffett was rationalizing having missed the technology boom, and they were startled to see him make such specific predictions, prophecies that surely would turn out to be wrong. Beyond his earshot, the rumbling went on. Good old Warren, he missed the boat. How could he miss the tech boat? He's a friend of Bill Gates.
Billy boy.
A few miles away, at the River Run Lodge later that evening, with the guests at the closing dinner again arranged according to some invisible plan, Herbert Allen finally spoke, thanking various people and reflecting on the week. Then Susie Buffett took the stage beside the windows that overlooked the pebbly Bigwood River and once again sang the old standards. Later, the guests returned to the Sun Valley Lodge terrace, where Olympic skaters axled and arabesqued in the Saturday night ice show. By the time fireworks exploded across the sky at evening's end, Sun Valley 99 had been declared another glorious 5-day extravaganza. Yet what most people would remember was not the rafting or the skaters. It was Buffett's talk about the stock market, the first forecast he had made in exactly 30 years. CMQ investors, that is the chapter. As I said at the start of the episode, I don't want to influence your thoughts on what all this means. If you're interested in my thoughts or you just want to learn more about the connection between 1999 and 2021, I've included those details in this episode's newsletter post. Sign up for our newsletter for free at cmqinvesting.com. A lot of our newsletter posts are all about Charlie Munger and Warren Buffett's wisdom, specifically how it relates to investing. And speaking of Charlie Munger says that the best thing a human being can do is help another human being know more. The easiest way to help someone else know more is to share this episode or any of our episodes with them. If you're listening through Apple Podcasts, please rate us 5 stars and leave a brief written review. It doesn't take long, but it goes a very long way in helping more people discover compound money quietly. I also just genuinely love reading them, and they're very motivational. I want to make sure I say thank you to all of you who've left reviews so far. It means a lot, and like I said, it really does motivate me. If you have any feedback, whether it's questions, comments, criticism, or you just want to say hey, please don't hesitate to email me directly. I set up this email just for you. It's franco@cmqinvesting.com. franco@cmqinvesting.com. With all that said, my name is Chris Franco. This is Compound Money Quietly. Thank you for listening. We'll talk soon.